Hello and welcome to Portfolio Matters Share Talk. In this week's Share Talk, we will be discussing the newly listed oil company Harbour Energy, which was created by the reverse takeover by Premier Oil of private equity-backed Chrysaor, and it is now the largest independent producer in the North Sea. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Over to you, Keith.
Thank you, Richard. Okay, Harbour Energy is a newly listed oil and gas exploration and production company formed by reverse takeover by heavily indebted Premier Oil of private equity-backed Chrysaor. And its share price, frankly, its share price since it was listed only, I think, 3 weeks ago, has drifted off somewhat and is now down at 19.2p, has a market cap of 3.6 billion. But despite writing off a chunk of Premier Oil's debt and doing a debt for equity swap, it still has a lot of debt. This is a heavily indebted company with 2.7 billion of debt and an enterprise value of 5.5 billion. Okay, in summary, we are going to say that these shares look decent value, actually, based on the calculation that we can do given the limited amount of information available. Obviously, it's newly listed and there are as yet, no annual accounts. In fact, details of things such as the exact mix of oil and gas produced are quite limited. So we will know more when they produce their first results. However, there are risks involved with this. It's mainly in the North Sea, which is a high cost production area, and it's got a lot of debt. So on the plus side, it should be highly geared to a rise in the oil price, but there's also a lot of equity with former debt holders who are not natural holders of those shares, and I suspect will be steadily selling out of them. So in the near term, I can't really see the share price moving that much as all these former debt holders try and sell their shares. Okay, so this is the share price of Harbour Energy over, of course, the last few weeks since it's been listed. And you see, after initial euphoria, it's been steadily drifting off. And I bought some back here and I'm underwater. And as the crude oil price rose earlier in the week, its share price perked up and has since drifted off again. Okay, so this is the unhappy story of Premier Oil, which was a heavily indebted UK oil and gas producer. And when the oil price was doing well in early 2018, share price was very strong. But then as the oil price came off, obviously as highly indebted, its share price more than halved. And then when the oil price collapsed because of its debts, I mean, that was curtains, essentially. It was considering doing a large equity placing to survive, but then it decided instead to do this reverse takeover of Chrysaor and a debt for equity swap. Now, the terms of the reverse takeover were pretty harsh, actually, for Premier Oil creditors, in that they had debts of 2.7 billion, of which they received cash of 1.23 billion, plus new shares. The effect was creditors received cash plus shares equivalent to 75 cents on the dollar. And Premier shareholders only hold 5% of Harbour Energy. Former Premier creditors, so debt holders, own 18%. Chrysaor shareholders, so these private equity backers, EIG Global Energy Partners, and related parties own the remaining 77%. But if you think about the situation now, all the private equity backers, their shares are subject to a lockup, and their minimum lockup is 6 months. So right now, only 23% of the shares are available to trade, and of those, over 75% are in the hands of former debt holders. And so there's a big stock overhang. This is Chrysaor, and Chrysaor became the largest independent North Sea oil producer after purchasing the assets, North Sea assets of Shell for 3.6 billion in 2017. And they were backed by this private equity group, EIG Energy Partners. And they've now inherited this position in Harbour Energy. So EIG Energy Global Partners own 36% of Harbour with a 12-month lockup. Former EIG shareholders own 33%. I don't know who they are. And Chrysaor legacy investors own 8% with a 6-month lockup. So the shareholdings are really quite concentrated. You have 23% of the company is owned by former Premier people. And then this private equity firm, will they want to continue holding shares in a publicly listed company, or they want to get their capital back and recycle it in new opportunities? There's potentially a very big stock overhang in this company. So who are Harbour? So Harbour now have producing assets, mainly in the North Sea, but some in Vietnam and some in Indonesia. They also have a big development opportunity in the Falkland Islands basin, and that will be high cost. And they also have inherited Premier Oil's portion, 40% holding in the Zama field in the Gulf of Mexico, which we have talked about elsewhere, talking about Talos Energy. And that field is currently subject to unitization negotiations between Talos Energy and Premier, and on one side, and Pemex on the other. Now, we did a separate share talk on this, on Talos Energy, and anyone who's interested in further details should look there. This is the leadership, and they are oil people. That's good. They're not finance people. Linda Cook was retired from Shell in 2010, and 29 years there, included CEO of Shell Gas and Power, CEO of Shell Canada. Phil Kirk, who's the CEO of Europe, established CH4 Energy in 2002. So these are oil and gas people, they're not finance people. One of the things that Harbour are saying as an attraction for their shares is that outside the majors, there aren't many global diversified oil and gas companies producing more than 100,000 barrels a day. So there's North American focused companies, mainly doing shale. There are small specific asset and region focused producers. And then there are diversified small E&Ps, all producing less than 100,000 barrels a day. Harbour would claim that they are big and diversified, but actually, I don't think they're that diversified. They're mainly North Sea, frankly. So they're the largest producer in the North Sea now, but that's both good and bad. I mean, it's a high cost region that has been well picked over. And so recent developments and discoveries have all been quite small, with, I would say, a checkered history. We will talk later about Solan, which was a discovery of Premier Oil and was one of the reasons they got in so much trouble. Solan was meant to produce 25,000 barrels a day and never got anywhere near it. Within a couple of years, it was only producing 2,000 barrels a day. These are some of its UK production assets. Now, good news is that the Tolmount gas field, which was a Premier development, is due to have first gas anytime now. And there's further exploration and development in Tolmount East. So that is near-term upside, development upside. The J area is currently producing 31,000 barrels a day. And they're saying there's some low-risk exploration opportunities nearby. The Greater Britannia area is producing 40,000. And there are more opportunities in the region. And they're aiming to do some workovers to maintain production. Now, if you look at where Chrysaor have come from, all their assets, the main assets, came from Shell. And when they bought the Shell fields, effective date 1st of July 2016, the competent person's report was expecting those assets to decline steadily, as shown in the dark blue line. But Chrysaor managed actually to maintain or increase production from them. And as a result, the cost per barrel, operating cost per barrel, instead of rising as expected, declined. So if you can keep production up, then you have lower operating costs. And with the profits, they very rapidly repaid debt. The 3.6 billion they had paid Shell to take those assets. And if you look, 2016, when they took over, they had reserves, 2P reserves of 305 million barrels. And now, so 1st of July 2020, so 4 years later, they had 90% reserves still remaining. So having produced 169 million barrels, they had replaced 90% of those. They are saying that they have a path to net zero emissions by 2035, in part because the Acorn carbon capture scheme. Now, it's not clear to me exactly what their role in this is. The Acorn has its own separate website. The economics of this largely depend on government subsidies or government carbon capture costs. So this is all for the future. Okay, so if we look at their assets around the world, they have exploration assets in Vietnam, Indonesia, Falkland Islands, Brazil, and Mexico. Of those, the main ones are Mexico and the Falkland Islands. Now, part of the Premier's problem was that because it was so highly indebted, it couldn't really afford to do anything on its own anymore. So having made the tuna discovery in Indonesia, it then farmed out half of it to a Russian company, Zarubezhneft. And they have taken 50% of development in return for agreeing to drill 2 appraisal wells in Q2 2021, i.e. now. So more near-term upside. But their big asset is a 40% holding in the Falkland Islands Basin, which was discovered by Rockhopper. And the Sea Line development, these are big assets. These have their contingent resources, but 2C of you know, half a billion barrels. You know, these are enormous resources. The trouble is that this is an isolated basin. There's no infrastructure there, and all the equipment for developing the fields would have to be brought across the oceans. So it's going to be a very high cost development with a break even of around $40 a barrel. So really, in order to do this, they would need to see the oil price consistently above $60 for the whole cycle. And, you know, you're getting there. You'd hope if the oil price were to rise further from here, then the sea lion development becomes economic and they can get financing to do it. And this would be an enormous upside if oil prices stay high. But the bottom line is, over the last decade, shale oil has consistently killed the oil cycle whenever oil prices have risen strongly. Now, we know that in the US, several of the shale oil basins are largely depleted, such as the Bakken, to the extent that they won't be growing further from here. They may be able to maintain oil production, but they certainly won't be growing. The only region which can grow strongly is the Permian. So the question is, the supply shock that came from the development of US shale, has that largely played out? And will that allow the oil price to stay high for a few years to allow sea lion to be developed? Moving on to the finances of Harbour. Harbour have inherited $4 billion of tax losses from Premier, and that means they won't have to pay any tax for 5 years, hopefully, which should be good for dividends and buybacks. But they have net debt of 2.9 billion, although the cost of that debt is below 5%, which is good. They've also hedged 12 million barrels at $60 a barrel, and they've also hedged 25 million barrels of oil equivalent gas at 44p a therm, which is substantially higher than the prices that Premier Oil realized in either 2019 or 2020. Like I said, going forward, they are guiding to production of 215,000 barrels a day, although that will be the actual production of the new entity, but reported production will be lower because they will only include 9 months of Premier Oil production. There will be very substantial capex for maintaining production and toll mount development. And cash flow break even is estimated to be $30 to $35 a barrel. Okay, let's do a very rough calculation based on the limited information we have available to us. So they are guiding to production of 215,000 barrels of oil per day, no split between oil and gas. Cash flow break even is $30 to $35 a barrel. Now, I emailed the company to ask what that included, and I got this back. Dear Mr. Jordan, free cash flow break even is after everything, including all capex, interest payments, one-off transaction, tax payments, etc. It also takes into account our hedging program. Right, so that's good. Okay, so let's first of all, let's look at a conservative case. Let's take the low production guidance of 200,000, 95% uptime, 2021 average oil price of $58. So in Q1, the average was 58.5. Cash flow break even on the high side. That gives revenue of 4 billion, cash flow of 1.6. So at a 20.6p a share, and I did this, frankly, a week and a half ago, and the share price is now 19.2p. So this will look even better. So that gives a free cash flow multiple in US dollars of 3.3. Okay, moving on to an optimistic case. Production of 215,000 barrels. per day on the high side, 97% upside time, and will increase the average oil price by $5 to 63. Bear in mind, we've already had one quarter, and the average over that quarter was 58.5. So you're then assuming that the oil price will be substantially above 63 for the rest of the year. So, and then we take a cash flow break even, which is an average, 32.5, revenue of 4.8 billion, cash flow of 2.1. That gives a free cash flow multiple, again at 20.6p of 2.5. So this looks good. But, and there's a big but, we have assumed that 100% of Harbour Energy's production was oil. Actually, it ain't. Investors Chronicle, and that is the best source of it I can find, is that Harbour Energy's output will be around 50-50 gas oil. So, using their hedge of 44p a therm and assuming that will be the average across the year, you can convert that into dollars a barrel thanks to this website, www.sigma2.com, and that works out at $35 a barrel. So assuming that we do have oil at $60 for the year and gas at 35, 50-50 mix would be 47.5 per barrel of oil equivalent. So let's redo those numbers. And then you get the conservative case, P ratio, a free cash flow year, multiple of 6, and on the optimistic case, 4.2. So that looks all right. Looks pretty good. The Jefferies have an NAV of 25p. The current share price is 19.2 and price target of 30p. So that is from where we are now, a 50% upside. The current price is actually 19.2. These are the historic numbers. Now, the historic numbers are all from 2019 backwards. Those are all Premier. Going forward, you see a big uplift in revenues, and our own calculations are more optimistic than this. We're saying revenues will be higher. So positives. Well, above all, it's an oil company that makes, frankly, no bones about being an oil company. This is not going to be doing wind farms. And if you want exposure to a rising oil price, then this seems like a good medium-sized 200,000 barrels a day producer. It's got gas coming online soon from Tolmount and more from Tolmount East, hopefully. There's near-term upside, possibly from the Pemex negotiations over the Zama field. But as we've discussed elsewhere, that's with the Mexican courts, and the Mexican courts have a history of favoring the national oil company. But the latest we have heard is that Pemex are open to allowing Talos Energy to remain the operator of the field. And that is very positive because Talos will be producing from the field. If the courts were to rule in favor of Pemex and give Pemex the operatorship of the field, then Pemex are very slow and you could see years and years before the field gets developed. They've got this big potential upside from the Sea Lion fields in the Falklands, which could be developed if the oil price remains high. And it's good position to pick up further North Sea assets, having shown that it can maintain production from old fields. And based on our calculation, which is admittedly very rough, the shares look pretty good value. And it's got 4 billion of tax credits, so it won't be paying any tax anytime soon, which is good for dividends and buybacks. However, there are lots of negatives. So it's come out of private equity, essentially. Private equity will own 77% of this company, and as a result, it's heavily indebted. It's got 2.7 billion of debt. And also, the oil sector is deeply unfashionable. There's possibly the biggest negative is the massive stock overhang from the debt to equity swap, and also from all the private equity backers who have now got shares in a publicly listed company, and when their locked in period ends, they may well decide to sell. Also, there's going to be one big shareholder in the form of the former private equity backers, and governance could be an issue. It's in the main assets in the North Sea, which are high cost. So its cash flow break even is as high as $35. So that's good and bad. It's highly geared to changes in the oil price. The Falkland Islands Basin, which is its main exploration asset, frankly, if the oil price doesn't stay high, that may never get developed. But if oil prices rise, then that will look increasingly attractive. And to go back to Solan. So Solan was one of the big problems for Premier. Premier took on a lot of debt to get Solan developed and was meant to produce 25,000 barrels a day. It only produced 2,200 by H1 2020. And then they did a new horizontal well, which was meant to lift production to 10,000 barrels a day by Q3 2020. And actually in Q4, it was only 7,000. So Solan remains a problem. Be interesting to see what Harbour can do with it. And as we've said, there are no financial statements. So right now, there's quite a lot of guesswork involved in trying to value the company. And all our calculations should obviously be treated with quite a lot of caution, given the lack of granularity we have and the amount of guesswork we are doing.
Great. Well,
Richard.
Thank you very much for that, Keith. Very well researched review of Harbour Energy. And obviously, it's a company that has some great opportunities, as exemplified by the positives, but also some problems, as you referred to in your negatives. It also has a good management team. And I guess that if you place some reliance on the effectiveness of the management team, they will be able to minimize the negatives and maximize the positives. As you say, as an oil company, it's vulnerable to the oil price, but it does appear to be able to replace its reserves as it uses them up. So I would say it probably isn't going to be a company that's going to be a short-term multi-bagger, but it could well be a long-term good performer, couldn't it?
Absolutely. I don't think, you're not going to treble your money with this. But I think that actually, if oil prices rise from here, it's a high-cost producer with with producing assets in the North Sea, and it will chuck off a lot of cash. And it's got these tax credits, which means it, first 4 years at least, it shouldn't be paying any tax. So it's got the opportunity to pay off a lot of debt and return money to shareholders. My concern would be that, its model over, its existence with buying assets from the majors, from Shell, and then prolonging the lives of the fields. And I wonder how many more old oil fields there are in the North Sea for sale. I think the majors have now largely left. So then it has to do its own work, basically. And it's got so far these fields from Premier. So it's got the Zama field, and it's got these Falklands assets. But those all have problems. So
you can see the Falklands assets could be a positive, but they could also be a negative. And it's a sort of negative that if it's managed badly, could be a money swamp, just draining cash away from the business. And as you say, it's a high cost field, and it's very dependent upon the oil price staying at a relatively high level. I mean, It's a very interesting company. I think you've presented it in a very balanced way, Keith.
Well, I bought some of this, and frankly, I'm underwater. But the thing is, the bottom line, actually, short term, I think there's just this enormous stock overhang.
Yeah.
When 3/4 of the shares with people who don't want to hold them is the bottom line currently.
That's what rather suggests there's no rush to get in there, doesn't it? And you've got time to see how they manage to develop the existing reserves, the existing projects, whilst stock overhang probably gently clears.
Yes, you'd hope it gently clears.
Keep my fingers crossed for you, Keith.
Yeah, right.
Great.
Okay.
Well, thank you very much, Keith, for that. It was great.
Good. So I hope you all will press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Bye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.